Alrighty, welcome back to another episode of On the Margin, Roundup edition. Guys Emporium, what's going on, guys?
Fired up.
Quinn had 2 coffees this morning, and he looks like he's a hillbilly elegy guy. Look at this guy.
Slash Super Mario. Nice little combination.
It's like a love child of hillbilly elegy and Super Mario.
Yeah.
I'll take it. Hit me with everything you got.
Can we give a shout out to Nick Carter last night for his performance at karate combat down in Nashville? I watched him. It was shout out Nick Carter. He
brutalized that guy. David's probably super pumped that he quote unquote broke his rib.
There might be a round 2 there. You never know.
Permissionless?
What is going on down there? I saw it on Twitter and I was like, is that Nick Carter throwing like a high kick? I was not.
Did you see the Hawk Tour girls there also? What?
Yeah, so weird to me.
RFK was there. Your boy Tyler.
The simulation is breaking.
I mean, RFK. That's some big news, baby. If he gets into Trump's there's rumors he's going to be Health and Human Services Secretary, and in that case, a Bitcoin, buying $618 billion worth of Bitcoin reserve, the probability goes up a little bit. So I'll take it.
How did they get that number? Like Mike, you're saying it's so specific.
It's the amount of gold that they have in reserve. Yeah. So he said it should match the amount of gold that the U.S. holds in reserve. Because I was like, that is such a random number. Like, why 618 billion? But I don't know.
I mean,
I'm for it.
Let's get the 100 billion first, but I'm all for it. I mean, I talked to Lynn Alden last week and asked her about this, and she had an interesting take talking about how the U.S. government already has a lot of Bitcoin. Obviously, we see them dump on us once in a while, but they could very easily just formalize that ownership into this like strategic ownership, which would be really interesting.
I mean, if they can politically dump oil onto the market whenever they want to try and suppress inflation, why can't they toss a few printed dollars at the old orange coin?
This is true. Creating a geopolitical, it creates a geopolitical strategy game where game theory, you have to chase it, right? And then that becomes this new strategic asset. It makes a lot of sense.
What do you think the odds are that it gets approved? I mean, I think Trump he's supposed to be speaking at the Bitcoin conference, right? So tomorrow. So that's where people have been speculating he's going to talk about the strategic reserves. What do you guys think the odds are that it actually goes through? I guess we'll know tomorrow.
I don't think he's going to say it. Maybe he will. But even if he does, I want to sell, I think it's becoming consensus. I mean, you sell the news in every crypto event. We saw one this week with the ETH ETF, right? But I want to sell the news as bad as the next person. But the macro is so good right now that I don't know if I can do it.
It sounds like Senator Cynthia Lummis is going to have some sort of bill she's going to unveil there that talks about that. And I feel like it's just going to be some little like mini checkbox they can do of saying, oh, like she talked about this new bill talking about creating the policy framework for having a strategic reserve asset. And Trump's at that same conference and maybe he'll have a little side comment. And I don't know. I feel like that would be the most of it.
So guys, before we get into it, I just want to give a quick announcement here for listeners of On the Margin. A little bit of a bittersweet day for me, but formally announcing here that Felix has come on and I think taken over hosting of interview duties and running these roundups much better than I ever did or could. So a little bit bittersweet. Been doing On the Margin for 3 years, but I am formally transitioning off here. It's bitter because I'm going to miss all you guys every Saturday on the Guys Emporium. But I think it's sweet because Felix is already doing my job better than I ever did. And you guys are in very capable hands. So if you guys will have me back every now and again for a little celeb shot cameo appearance, I would love to join. But yeah, fellas, it's been real. Gonna miss you on the Saturdays.
Thanks, Mike. This is like, I don't even know if I talked about this on here before, but I was like one of the very, very early listeners of On the Margin, like back when it was mostly just Mike and Tyler way, way, way back. And it's been really cool to see the evolution and definitely pretty honored to take the next step here. And yeah, doors always open. Hopefully we can wrangle in Mike once in a while for a little celebrity appearance. But yeah, I really appreciate it.
We'll miss you, Mike.
Mike got a haircut to announce his resignation. You know what I mean?
Hey,
Look clean.
When the listeners hear this tomorrow, it's going to be as live as Biden's 8 p.m. speech was with his 6 p.m. watch.
I saw that.
I was on a call with David Hoffman actually, and he was like, "Mike, is that a mullet?" And And I was like, I need to get a fucking haircut.
You said those are fighting words, and he's like,
yeah,
oh,
I was like, okay, it's gone way too far. Yeah, I gotta clean this up. Sorry, Felix.
One last housekeeping note before we get into the goods here, but we'll also be releasing a survey of sorts next week, just to get a bit of a pulse check on, the evolution of On the Margin. There's been a few different renditions of it, and again, we're super excited about the next evolution of it, and just want to get everybody's input into it. So have a look for that in next week's episode, and there might be some good reasons to fill out that survey, so keep an eye out. Anyway, I want to set the stage by just running through some data points that we got this week, and then we can jump off from there and see where everybody's takes are at, if that sounds good with everybody. Yesterday, we got the GDP print for Q2, and it came in hotter than almost all analyst estimates, other than one at 2.8%. And that was really interesting because that's starting to align with, I think, a lot of what we've been nailing here about this minor slowdown that we've been seeing over the last couple months. But I think none of us were calling for any sort of recession, and I think this is really starting to nail the head on that. So if you just look a little bit deeper into the composition here, the most interesting things that I saw is that we saw a pretty significant rebound in personal consumption expenditures. That was really a core driver of this upside in GDP. And it was also still dragged by that negative net exports, which has just been this dynamic that's been largely driven from the strong dollar. Looking a little bit deeper, a lot of that growth also came from goods growth, both in durables and non-durables. So the previous quarter, we actually saw this contraction in durable goods and non-durable goods, and this has aligned really nicely with what we've been seeing for the past year or so, where a lot of the disinflation and even deflation that we've been seeing on a month-over-month basis in CPI has been coming from goods as opposed to services. So the fact that we saw this rebound is starting to make me feel more confident in this idea that we've seen this soft patch of economic data over the past couple of months, but we're starting to rebound and see this reacceleration higher again. And just to really set the stage of how important this is to be looking at this goods growth is just comparing like core services to core goods CPI. Like, as you can see here, we've been in deflation for goods for a while now, and that's been really the core driver, while core services have been staying pretty much sticky and elevated. The other thing we got this morning was personal consumption expenditures, PCE. This came in relatively in line with expectations. Core PCE came in a little bit hot at 0.2% month over month versus the expected 0.1%. But other than that, for the most part, everything was largely in line with expectations. So those are the two big points that really covers. We got the growth side and we got the inflation side. And just to set the stage of our conversation, if you annualize that 3-month average of core PCE, you're basically at 2.31%. And the pre-COVID average is 1.93%. So I don't know. I feel like we've almost seen the soft landing. Like, I don't know how you could get that much further when you look at the really granular nuts and bolts. But that's what I'm seeing. It feels like this slowdown has ended, and we've started to see this bit of a bounce higher in economic momentum. What are you guys thinking?
I tweeted this morning, but if you read the GDP release from Q2, current dollar GDP increased 5.2% in the second quarter, up from first quarter 4.5%. Nominal. So this is nominal. But why is recession even on anybody's tongue? I mean, we have not had below a 4% growth rate nominally in years, and it's this fiscal dominance. I mean, like, people, these soft patches that we go through. Q2 was the worst quarter for liquidity measures since kind of like Q2 or Q4 22 type of thing. We had the RRP it actually rose, so that was a liquidity drain. We had QT still going full bore before it tapered off in June, and then we had the TGA build too. So, and taxes. I think it's just crazy to talk about recession here, and I would go out on a limb to say that today's big move down in oil is kind of this like last capitulation flush. Because, I mean, just think about it. The government is spending annually 6% extra than what they bring in of GDP. So if you assume they're not horrible allocators of capital, we should be growing at 6% per year. And that's going to come in nominal GDP, which could be 6% inflation, 0% real growth. It could be 2% real growth, 4% inflation. And what we're seeing right now is it's 4 and 2 or 4 and 3. So I think this is an extremely supportive time for the economy broadly. Now, how does this develop for markets? I think we've seen a sneak peek. We've had a couple weeks of this small cap boom, and tech has gotten hurt, and that caused some tremors through the broader markets. That probably, like, if you're racing to get small caps here, you're late, right? Like you're 3-4 weeks late. But I don't think you're late on a multi-year horizon. I think we see some reverberation to the mean, but that doesn't mean that I think that trend is over. So it's going to be a couple interesting quarters ahead, I think, because people are going to remember back to 2022 that what's good for the economy doesn't always mean good for the markets, and this whole dichotomy two-speed of Main Street versus Wall Street thing. So we just got a glimpse, but pay attention. Usually this upcoming period is pretty good for risk.
I'm going to add to that. If you look at slide 16, one of the most fascinating things in the market is no one's paying attention to forward-looking inflation. It's all lagging. Every analyst looks at lagging, but this is 2-year forward break-evens, pricing it at 1.78. A lot of that is oil weakness. I think oil weakness today is primarily because there's a ceasefire in Gaza chattered to be going through this weekend. It's part of it, but we're below 2% here on a 2-year break-even basis. So, and add to that, markets are pricing 2.75 cuts for the year now after the PCE this morning. September and December are both pricing close to 100% chance of a cut. November is pricing 70% chance of a cut. September is also pricing 10% chance of 2 cuts. So the Fed is going to ease. The market's telling you that. Basically, if you look at break evens, you have a real great nominal yield now because inflation is going down. Money is going into bonds. This equity volatility is primarily just a quant systematic deleveraging because of the market structure. Bonds are a raging buy here. And you're seeing that because bonds are having inflows. So I'm with Quinn. It's really fascinating watching the commentary on Twitter. Guys who are, 30 years in the business just can't wrap their heads around the credit cycle is starting again. It's like, watch out for the credit. They're not even looking at bonds. It was the funniest thing, if you are a bond investor and you see inflation dropping and inflows heading into bonds in bond funds, you would think everything's fine. But everyone's calling for this giant credit crisis. Now, if that's a geopolitical thing, you see credit spreads rise, that's different. But that's not what we're in. We're seeing a giant rotation in growth here, which is heading from large caps, which are overcooked to the upside. This is what the systematic quant funds do now, is they take everything to such an extreme, and then when it reverses, it happens really hard and fast. So growth is, earnings growth is falling in large cap tech, Mag 7 specifically. We saw that from Google. We'll likely see it from the semis, and that's rotating now into, smaller caps. So something like Quinn said, maybe it's short term, don't buy IWM here because it's overcooked, but longer term, I think this is going to be the trend. If you look at slide 13 that I had, this is a great one to show you how the earnings growth is shifting here. This is the S&P small cap, which is 600 stocks versus S&P large cap 500. And the dark blue bars show that there's almost 25% growth in smaller cap S&P earnings next year by Q2, which is that's the real rotation. We're going out to Q2 of next year, and the market's starting to price these earnings in. and you have a lower cost of capital from the fixed income markets. So this is the driver of the stuff right now.
The only thing to add on that is your buy bonds. You mean that as in corporate credit is strong, credit spreads are low? Because
Yes.
I think actually now is when you should be selling long-term treasury bonds. If you want to hedge, the hedge is short TLT in my opinion, because we're going to get rates rising, but rates rising for good reasons, meaning higher growth in the next coming 12 months. So I think your best hedge here is the easy money to be made in the AI shorts has been had. I mean, we're, people talking about watching Nvidia go down below 100. Yeah, it probably does someday, but we're talking a huge correction has already taken place in those names. And so from here, I think when you get this inflecting growth higher, I think shorting the long bond is the best hedge right now for risk.
And the twos to tens curve is actually saying that too, which breaking out of an inverse head and shoulders type.
I think that's a really good distinction. I mean, when you boil it down, like when I think about my process through the last couple months is when we started to see this slowdown start to crystallize, I was really, really focused on whether that was going to lead to an accelerated slowdown that was getting close to recessionary, or whether we see this bounce and reversal into this next leg and broadening out of this economic and business cycle. And I think what we're all agreeing on now is that it's looking like it's the latter and not the former. I think it's pretty clear that there's no major recession risk here. But that's what's so funny is like, I don't know if you guys saw this week, but there was an op-ed from Bill Dudley that came out, who was the head of the basically the New York Fed for a lot of years. And he had this Bloomberg op-ed that just said, I changed my mind. The Fed needs to cut rates now. And that was just, it was weird to see such a strong reversal and how urgent it felt. I mean, when you read the article, a lot of it is based on SOM rule dynamics, which we've talked about already, and how there might be some noise there due to the increased supply of the labor force, leading to an increase in unemployment rate. But really, it just really came down to those dynamics and mechanics that listeners have heard already. So it's interesting to see the pressure on it, even though what we're saying is that it doesn't feel like there's any sort of substantial recession risk at this time.
But one thing that's interesting about
Sorry.
this op-ed, by the way, as well, is I saw Joseph Wang tweeted about this, and he's always great to listen about internal Fed dynamics because he actually worked at the Federal Reserve as a trader. And Bill Dudley had a pretty influential op-ed back a couple of years ago when we were in a really different place in the cycle in terms of rate cutting. And he had this one line where he actually suggested that perhaps the Fed should actually cut rates to influence the election because of Trump, which I thought was very interesting. And so if you want to put your little tinfoil cap on here, another reason that he could be suggesting this at the current time is because, we're in election season here. And so, normally I don't really love, speculating on this type of stuff, but he already speculated in print in another very influential op-ed that maybe the Fed should consider the outcome of the election in terms of setting monetary policy. So he hasn't said it outright this time, but I thought it was just interesting that he's got a history of kind of writing these really influential op-eds at critical points in the market.
I don't need the tinfoil hat. I have a red USA hat on. Of course. Just put the two op-eds together and change the words because of Trump to because inflation is in the labor market. I mean, of course, like that's what happens every election year. There's a reason that election years outperform every single time.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for a DAS this year, and I hope to see you out in Salt Lake for permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
There's only one way up. Tyler, I want to pass it over to you to help explain in a weekly Quant Corner here what's been going on with this systematic flow thing that you mentioned. And at the same time, like I was just looking at a chart. This has been going around of just comparing the yen to the NASDAQ QQQ. And their correlations have been pretty tight over the last week. And a lot of people are trying to figure out what has led to this huge, sharp move in the systematic flow. Is it related to this yen carry trade unwinding? So I want to pass it to you and try to give at least a decent distillation of what have you been seeing in that respect, and how has that mechanics sort of worked over the last week or so?
Yeah, this is a poor man's description of it. But when the yen was devaluing against the US dollar, you can borrow yen and make money borrowing. If that yen you borrow devalues by 3%, you're making the money. You're shorting the yen. You're making money on that leg. And then you're also making money on buying the QQQ. So that was primarily the carry trade. You're borrowing yen and buying large cap tech. And when you have a standard deviation move, when the Bank of Japan says they're going to raise rates or cut bond buying, that causes this knee-jerk reaction lower because everyone's been short the yen for a year. So that messes up all the algorithms. It causes, sell stops to go off, and all the systematic funds chase this at the same time. They might have been the match that lit the fire. But you also had a setup because implied correlations, and we've talked about this. This is slide 15. Implied correlations hit 8, which is like an all-time low. Now it's at 1690 this morning. That's probably a little bit overbought in the near term. When correlations rise, the VIX can rise because that means all the stocks act similarly together. And you have a lot of these systematic funds function the same. When the VIX goes up, they delever their portfolios. So as the VIX rises and implied correlation rises, they indiscriminately sell everything. And you see these giant quant sell programs. This is a lot of the function of this is it's kind of stupid because you used to have traders individually trading each stock. But because spreads collapsed and you could have a quant, I can trade 30 stocks at once now and put in a giant sell program. And that happens, and it short term messes the value up of these stocks. And then that money slowly flows to where the algorithms say the growth is. So I think that's a lot of what we're seeing right now is when the VIX pops really fast, indiscriminately giant sell programs across basically every asset minus fixed income. And then that money slowly is flowing into like crypto equities. It's flowing back into IWM. If you look at like KRE, that's breaking out to the upside. Look at XLI. A lot of the old economy is now working because of this blow up in the dispersion trade. And it potentially, what I think is that we might have seen the blow off top in large cap tech. It's becoming clearer as time goes on. And we see the politics shifting. Clearly, Trump doesn't want a large tech dystopia. Ben Horowitz, we've talked about all these themes over the past couple of weeks. Now that money's dispersed, there's dispersion in the market now, and it's going to other places. And I think that's going to be the theme for the next couple of years, honestly, because we need a more distributed growth.
Part of the reason, Tyler, why I love why you describe these these sort of systematic mechanisms in market that have an impact on how capital flows through to different companies is there's a real world impact to all of this, which is there's basically been a huge oversupply of capital to a very specific type of company in the US. And so, people have been complaining forever that no one cares about profits anymore. Like, in a sense, like if you were to read crack open your economy textbook, it'd be like the more ability a company has to get funding is good. But there's some kind of bell curve there where actually too much funding it allows you to paper things over for a really long period of time. And it's actually, I think it's actually not good in the long run. Like you can oversupply capital to a company and then they can end up making much worse operational decisions for it. So like these market structure dynamics actually have real world outcomes here. And that's why you see these like crazy dynamics in tech companies where, people just get paid a ton of money to like do not that much work. And then there's this weird like social reflexive cycle where, the people that work at these sorts of companies have a specific worldview or ideology, and it seems like they're winning. Like these like market structure things have a massive impact actually on real life. Also, I think it's just worth highlighting that it's not just like some numbers go up more than others. Like this actually impacts the world in a really profound way.
I mean, it's kind of like George Soros' like reflexivity thing. It's fascinating how systematic flow like this is affecting real world economic mechanics. That's a really interesting thought, Mike.
To your point, remember when Texas and the oil patch in the US was crushing it? Oil was at $150 a barrel. You had a lot of influence on politics.
You did, yeah.
And so this stuff happens throughout time, but it's important to realize. I actually want to go down one tiny rabbit hole, if that's okay. Check out this. This is kind of fascinating to me. This is slide 18. Now, this is the Chinese yuan versus the Japanese yen on like a 30-year chart. And what I think we're really doing is we're redrawing export partners. And this is part of why there's disinflationary pressures. So the yen was weakening massively. Look at that like base, and it broke out through 20 yen to the yuan. And as the US, we're going to be buying less and less from China going forward, and probably more and more from Japan. And that's probably causing this overcapacity in China, where they're having this real estate problem. Now they're oversupplying the market with copper, with all these other things, because they're actually losing on a FX basis to Japan. They're becoming less competitive. So they have to, weaken the yuan as well. But this looks like a new regime to me, where maybe the yen keeps weakening over time and they become this export powerhouse relative to China, and we buy goods from them and starve China from our US dollars, which causes an overcapacity in oil and whatever. You name it, everything that China manufactures, which is kind of a funky way to think about it. And at the same token, that allows us as the head of capital for the world to devalue the dollar and rebuild our manufacturing capacity. And one other chart that I had in there was chart 14, something you probably wouldn't see. Factory investment volumes are running at almost double their historical peak pace. So we're reindustrializing the US manufacturing base in the face of this. Now, I got to give Biden credit. I was not expecting this chart. It probably was set off, during Trump's first presidency. But now this might go into overdrive. Like if we want to reindustrialize the US with a weak dollar policy, it's kind of fascinating watching these. This is the longer term stuff between our feet. That we're watching.
What's interesting? I saw this chart on Twitter too the other day, and somebody made an interesting comment about how it's been interesting that this hasn't really shown up in ISM surveys. Like manufacturing surveys have been really soft, and you wouldn't really expect us to be going through this huge, build out at the moment. It looks like it's sort of the opposite, which I find quite interesting.
Well, also, I mean, maybe there's a political element to here. Maybe it was Trump or Biden or whatever, but isn't the other big variable here that this all happened in 2020, like this investment, right? Like when COVID happened?
Yeah, tectonic shift in COVID.
Yeah.
And look, there's just in Texas alone, like Samsung's building, I think it's like a $5 billion plant an hour from where I live. There's giant investment in semiconductors in Arizona. There's a lot of this stuff. They're trying to rebuild capacity here and incentivize companies to do it. And it's happening right now, but it happens slowly. But you see it in the FX over time.
There's also, in the same way that finance is like sort of self-referential and the metrics that everyone decides to pay attention to become self-fulfilling prophecies that like everyone looks at the same thing and then they start to matter. The same thing happens in like business circles as well. So in supply chains, there's a supply chain trilemma also. It's like cost, quality, and speed. And basically for years, everyone just way over optimized for cost, and they outsourced it to places like China or Vietnam or Indonesia or whatever. But what you're missing there is speed, and the amount of the delivery time in inventory is directly proportional to the amount that you actually have to keep on hand. So there's like a massive benefit actually to having like a much tighter timelines on your inventory supply chain. And I don't know, I could see once that rhetoric starts to kick up, a couple supply chain gurus make speeches at conferences, it becomes a trend. Like, I don't know, these things tend to be like self-reinforcing and kind of build on each other. And it's in the same way that things happen in finance, that they also happen in like, bullshit business frameworks that consultants push, like it's the same thing.
Can I explain this simple? This is how I think about it in like using motions to describe the price action in small caps versus big tech. But it's basically, I think this current period, we'll see what happens with inflation, is either akin to like a September 21, maybe a Q4 20, or maybe a Q4 23. But small caps went nowhere for basically 2 years because we had higher rates. Remember, we talked about in previous episodes, cost of capital. If you're big tech and you have negative net debt, tons of cash on the balance sheet that you're earning 5% on, cost of capital, monetary, financial conditions, super loose. If you're a regional bank that funds yourself at the federal funds rate, or you're a mom and pop small business, cost of capital, financial conditions, extremely tight. And so what's happened is like the dollar's been strong because it's a safe haven currency when growth is slowing, and everybody wants to pile into dollar assets. We know that's not the treasuries because they're being printed at 10% per year and supply is brutal, kind of like a shit coin. And what is left? It's NVIDIA, the secular AI trend. And so we saw in Q2 when everybody's getting the loudest about AI because it's the safety play, there's nowhere else to go. It's squeezing higher and everything else is bleeding lower. And then what we have happen is, oh crap, this inflation print in June just, put the nail in the coffin, or was it July or whatever, and sent things in small cap land, real economy land, banks, financials, home builders off to the races again. And what happened is, as Tyler mentioned, the systematics were short the small caps and the cyclicals and long the safe haven tech. That flew in their face. They had to unwind and deleverage. But that, we just said, GDP is still growing at 5 to 6% nominally per year. NVIDIA's sales are going to keep growing nominally. They might not command the huge multiple they did, but the stock's not going into the ground. Like, it doesn't need to go to zero. It just needs to stay flat and everything else can stay high. So I think that's the dynamic here, that people are like maybe getting too bearish just because we had this sell-off, which was largely technical driven, because it's self-reinforcing. So what's going to happen now is all this stimulus via rates, people arguing about, September, July, 25.50, the stimulus to the market's already happened. Look at the 2-year treasury rate. It's already saying cuts are coming. It's already loosened financial conditions for banks. It's already steepened the yield curve to improve their profitability. Long-term treasuries have even come down, which has improved their balance sheets. And so the stimulus effect, we're talking about what's the Fed going to do? When's the Fed going to do it? The stimulus effect lives in the market, and that's already happened. So what we're going to see is home activity, new housing starts, housing sales. All that's going to bottom and come back, and we're going to go back to the same playbook we've had where, can this market continue? Depends if inflation. And oil's telling you inflation's not a problem right now. It's down 2%. So bid risk. And these trends are so impactful, so self-reinforcing. They take time. So like to just want to fade assets here because we had this sell-off and because small caps have ran already is just, that's the Q2, Q1 playbook. Like first half, we're in a new regime, huge shift.
To your point, check this out. This is kind of interesting. Slide 10 is the Goldman short basket. This is fascinating. It almost looks like, I'm not a technician by any means, but like inverse head and shoulders over the past 2 years. And the pain trade is a lot of these hedge funds and systematic funds are short this stuff. And if you have inflation kind of at bay, this stuff will probably keep squeezing.
Yeah. Can you quickly explain this index? So it's a basket of the most shorted stocks.
Yeah, most shorted hedge fund stocks. And
Goldman puts together baskets for these themes. They have a Trump election theme, a Biden election theme. They have Goldman's most shorted. They have non-profitable tech. And so for their hedge fund clients, they put together these baskets that people say, so you can, put in huge block trades and highly liquid indices through their desk. And this is their shorted, kind of like their garbage patch tech basket, basically.
The interesting thing is that this is almost the mirror opposite of the Goldman momentum basket, which is all semis. So you could see semis implode and the shorts, like the market will do the most painful thing for the most amount of people. And I think the concentration of capital that's happened in large cap tech and specifically semis will come out, and that will squeeze the shorts. And
I want to agree, but it feels like you're going against that passive bid, and I don't know how that resolves itself, Tyler.
Yes, Felix, can you go back to the yen chart of tech and yen? Yeah. Okay, let's agree that this all started because good economic growth reasons, right? Inflation is dead for now. I don't think it's going to be dead soon, but that's what the market said with CPI. Small caps ripped. It squeezed the shorts of the hedge funds. They had to degrow. So they had to sell all assets. Gold got hit. Gold should not be down. Okay. We can say then also it's correlated to this yen move and rewinding of that risk. Why? Because inflation being, not a problem, Fed hikes going from uncertainty for 1, certainty for 2 to 3 this year means weaker dollar. Okay, so the yen strengthens. But look at here and where we are on the yen dollar chart, we're back to like April, May levels. Okay, so for this huge tech sell-off to continue right now, not saying they can't go lower from here in 6 or 12 months, but from right now, you need this yen to go from, bottomed at 152 down to like, maybe it stops at 150 or something. And we're back at like the November, February, March, resistance level. But
I agree
zoom out. What's changed? Not like the macro picture hasn't changed. Why should the yen be like gig ascending right now? The US economy is still stronger. We're still, like there's no, like, this isn't the end of it. Basically what I'm saying, there's going to be a point where you put on this trade and you ride it, in my opinion, but the macro isn't changing. Like the US economy is still much stronger. And like, there's no reason that like the yen monetary policy is still, they have rates still at 0%. There's no reason that the yen should just go like crazy strong here. And
just to contextualize, like the yen can go down from 2 reasons. Either if, the Fed starts cutting rates more than expected, that would probably bring it down. Or what's that?
You mean strengthen the yen?
Yeah.
Sorry, strengthen the yen. Or the opposite side, if Japan gets further hawkish and starts to talk about raising rates. Those are the 2 levers, because we're talking about a currency pair here. So,
which we do have. What I would argue is, I totally agree. And Fed is priced at 3 cuts this year, which like they're not going to 6 or 4 or 5 with how strong the economy is. And then 2, the other side that you said, if the Japanese said, all of a sudden we're going to get more hawkish, which they do have a meeting coming up where they're expected to talk about tapering bond purchases. But every single meeting they've disappointed and been dovish. Every single one. Like it's all this like, whatever they call it, like dovish hikes type stuff or whatever. They've been dovish. They have no reason. Like they need their exports to be competitive globally. I just, if that's the biggest risk I see. If the BOJ comes out and is like surprisingly hawkish, put everything I just said to the curb, and that's my stop loss. But I will fade BOJ hawkishness 9 times out of 10.
I agree with that longer term, because they need to delever their economy and they need nominal inflation to do it as well. This is kind of like the push and pull when things get too weak, and then vice versa with the dollar got too strong, and it causes these. So we're I think longer term we're saying the same thing, but shorter term I agree with you.
I actually wanted to change topics and ask you guys about the ETH ETFs that launched this week. So we got ETH ETFs live this week. There are 8 of them. I can actually pull up, I think Farside, which is a really good reference for tracking Bitcoin ETF flows, now has an ETH ETF page as well. Quinn, I know you actually put out some thoughts on this and maybe how the situation for the ETH ETFs were a little bit different for Bitcoin ETFs. So maybe we'd kick it over to you first. But the you can see the flows here. So there have actually been net outflows for in the first 3 days of ETH ETF trading. I mean, we don't have the data for today, but they've been, I mean, it's all coming from ETH, which is the Grayscale product. And there's been almost 1.2 billion in outflows there, which has dwarfed all the other 8 new ETFs. So there's $179 million that have flowed out of the entire complex so far. So I would just be curious, like, what you guys think, what flows look like from here. And then, like, I don't know, you like moderately bullish or bearish or sort of neutral on ETH as an asset.
So what happened, basically, just like trying to be as quick as possible here, is everyone going into it thought, because the ETH discount had been closed for 2 months, whereas the GBTC Grayscale discount was not closed a single day before the launch, that there'd be less sell pressure. And what ended up happening was, because it was closed for so long, so many people had the basis trade where they were short the ETH future and long ETH. And they didn't sell ETH in the run up to the ETF. They just hedged it with the ETH future and clipped that basis premium, which is, kind of like a 10%-ish annual yield if you held it. And what that invoked on the first few days was basically a speed run of the Grayscale outflows. So in the first 3 days, we saw something like 12 to 14% of ETH outflows for the whole vehicle. And that's a metric we saw for Grayscale GBTC in like a week to like 8 days or something, 10 days. Around the edges here, it's directionally accurate. So it was speed run because the discount was closed and everyone could get liquidity. But what the key is to look at is the reduction in CME ETH futures open interest that's also resulted, meaning it's a delta neutral trade where I'm selling my ETH, but then buying back my ETH future. And the market saw this and is like, oh my God, this is horrible. There's no ETH demand. But I think it's deeper than that. I think that, and look, Solana is standing out as the clear winner of this cycle. Like it's really hard to fight that. And, I'm positioned very strongly Solana, but I think it's more of an ETH versus BTC game that people should be comparing, because these are the two mature assets. And to say this was a failure is just not true. The volumes and the flows are anywhere between 20, they're all above 20% of Bitcoin. And expectations, I think, were in the 5 to 10% range. So it's this kind of like negative sentiment starts feeding on it. But, we do have this upcoming Bitcoin sort of peak sentiment potential this weekend with Trump, this at the Bitcoin conference. Would not be surprised at all if ETH BTC local bottom was fairly soon. Personally, BTC, I think, has a very, very strong macro narrative. So it would, I kind of want to be biased towards BTC just because the narrative is so good. And my gut tells me that ETH inflows are stronger than people expect, but that in the same way, ETH BTC has been a local peak indicator in the cycle up to date, right? Every time ETH BTC runs, it's like, look out, the market's going to duck. I think that's going to happen again, because what you're going to see is TradFi people, the ETF investors, flooding into Bitcoin. Bitcoin price runs. It's just like gold and silver. What do? Oh man, I love crypto. I love precious metals. Gold's making me a ton of money. What's the next one? Silver. All right, let's bid that. That's going to be Bitcoin to ETH. That's going to be peak. And then that's a local top. That's my guess. And, I think all this ETH hate is a lot like, at the end of the day, if ETH keeps going down, that's really bad for the whole asset class. It is the bellwether alt of the asset class. So you can't subscribe to that hate talk, but it is funny how every time people get excited about ETH, the markets.
Yeah. I mean, look, I'm not a huge crypto cycle guy, but if I just think about how we went through last cycle and looking at that Bitcoin dominance, the peak in sentiment was around when Elon started talking about putting Bitcoin on the Tesla balance sheet. And we had the Michael Saylor type of idea start to be well understood. And then that was basically corporates bringing Bitcoin onto their balance sheet. Right now, what we're speculating on is on the next cycle being sovereigns taking Bitcoin onto their balance sheet. So we're speculating on the US government having Bitcoin as a strategic reserve asset. So to me, it does feel like we're tracking where we're getting really close to that same moment last cycle where private companies getting Bitcoin on their balance sheet kind of marked that top in Bitcoin sentiment and rotation into alts. Feels like right now we're getting that, but this time it's on the sovereign level, which is awesome. I mean, we're seeing adoption happen in action through these adoption cycles.
Yeah, I think that there's also a point where, I know, Quinn, you've talked about this a little bit, and I've really, I don't know. There's when for price discovery in alts used to happen, and still does for the most part, completely happen from a retail buying basis. And so actually, like, discourse on crypto Twitter is like moderately influential for a lot of like really small caps, but I think for like Bitcoin and ETH at this point, it's almost completely irrelevant. And so if you're like on crypto Twitter a lot, you're seeing all this like ETH hate and these debates and all that stuff. And I think that's basically completely irrelevant for ETH price action at this point. And I think if you're in this, and that's like gradually what's going to happen with crypto in general, is like some assets are going to graduate to being like the majors where TradFi trades them. And then whatever narratives TradFi ends up pumping out about these things is going to have and like the flows that TradFi dictates is going to have a much more impact on price discovery for these things. So if you're just like reading people's like bull and bear posts on Twitter, I think you're going to be continually surprised by what actually happens in the price action.
I want to throw out a little food for thought here. The markets, you're investing, you're trading, it's psychology. You're playing the other participants, you're playing the market itself, and you're playing your own thoughts. And if you look back to some of the common narratives we've had over the past few months, right? June was, oh my God, AI, right? NVIDIA, everything was just roofing. We've obviously had Solana, we've had BTC cycles. Another recent one in June, alts are done. Short alts and go away for the summer. It's over. Yeah. This cycle's not like the last. Yeah. Well, it just so happens that we've had a massive macro shift over the last month, and it takes time for that to work through markets. We just had restrictive monetary policy from global central banks, coordinated. We went like 2 years without a month with a rate cut, right? Or that there's like we've had 2 straight years of months with a central bank rate hike, and now that's gone. And it doesn't matter if the Fed cuts. People say, oh, they're not going into traditional easing cycle. They're only going to cut 2 or 3 times. I don't care. We're talking about the next 6 to 9 months. They're going to cut. And so then you think about the follow-on actions. And, maybe I'll eat my words for saying this. I own the most altcoins I've owned in many months right now. And why? Because we're at peak bear sentiment. Alts are going down forever, just in time for peak Bitcoin and liquidity cycle to come back. And I think it's going to run back the same as it always does. And people are going to be surprised. And we're going to see, along those lines, ETH's over, ETH's done. I hate ETH. The ETF was a flop. Where does this sound familiar? It sounds familiar right about January 22nd, 2024, when Bitcoin hit 38K after the ETF. And then what did we do? We went to 70. Okay. I don't need to bet ETH to I don't need to, be my whole portfolio in ETH to have this view. Because if that's the case, yes, Solana and every other alt is going to run harder than ETH. But that doesn't mean ETH's going to, be this huge, crap asset. Like the institutional narrative is going to come. It's always price, narrative, price. It's not narrative then price.
There's a note. We can maybe drop it in the show notes. There's a really influential article that I read years ago. A16Z put it out. It's called "The Price Cycle of Innovation in Crypto," and the causal impact of what drives price. Like most people think, you do something, it creates fundamentals and the price goes up because investors price those fundamentals. Maybe it happens like that in equity, but it does not happen like that in crypto. The asset moves first. The price goes up. That leads to attention, and then that leads to fundamentals. And honestly, the best illustration of that was Solana when it started to rip last year. And you heard all of these people very confusedly say, but there's no activity. There's no activity. And honestly, just go back and listen to On the Margin podcast or Belt. Like we said, the price moves and then the activity follows. And now Solana's beating Ethereum, even though that's a controversial statement, on like many, like total economic value type metrics, DEX volume metrics, etc. The price moves first.
TradFi does this too. The person who points this out beautifully, Jem Carson, who's just nailed this recent market and has given specifics. Like the guy's, I love him. He crushes it and offers a very differentiated perspective. But he points out this one, NVIDIA, October 2022. Nothing's changed in the business since then. Oh, I mean, obviously some things have changed.
The Taiwan risk is still there.
Exactly. And that was, everyone was selling it into the gutter because, Taiwan. And now no one cares. And really nothing's changed. It's always the case. And you should put that article, Mike, into this.
I've got it. I'll link it. I've got actually a more crypto specific prediction also with alts. I do think that some of the DeFi things that have been in the gutter for many, many years, I think they're going to actually start to do really well. And I think that the election actually has an impact on this and the regulatory posture in the US. But these things, if you look at them, they actually make a lot of money. Like if you look at the makers and the Aves and the Uniswaps of the world, they're generating a lot of revenue, but they can't return this. They can't show to token holders that they're able to even return. They're able to return cash, and they want to. I really get the sense talking to a lot of these like teams that they want to do that. They're just being held up by regulation. But you can see proposals starting to move in that direction, and I think those things would rip. And I don't know how that impacts meme coins. I know people are like on this meme coin super cycle thing. I don't know, but I think that would be an interesting bucket of protocols to bet.
Isn't it? This is a kind of a funky way of looking at it, but as you know, we see that liquidity cycle happen and money ends up going into the frontiers. How come there's not somebody that's really realized that it's about the story you tell on the frontiers? You need to tell a really cohesive story to get
memes.
That capital. Yeah, I guess that's what it is, memes now. But to me, like the crypto universe, especially the altcoins, like I don't know what is bonk. I don't know what the narrative is. What's the story there? Why it's so good for the public is what I'm saying.
You're spot on, Tyler. I know what you're getting at, and what I'm going to say is you're 100% correct, and that it's happening. You're probably just not deep enough into these memes and alts, but these memes typically derive from like the most common like Gen Z phrase, like locked in and aura and all these things. There's a derivation. There's a reason they exist. And I would say like you take a coin like Ondo, which I would never touch with a 10-foot pole because it's valued at like 20 billion. It's like a third of Coinbase's valuation and they make like a 200K in revenue. But they just sold this story that they're associated with BlackRock. And it's kind of come true. They've started doing things. And there's 0.0 fundamental valuation that backs it up. But everyone's like, that's the RWA BlackRock coin. And then in Asia, it became the meme coin where one Ondo equals one condo. And this storytelling,
that's hilarious.
It's an Asian meme coin. One Ondo. If you own one Ondo, you own one condo in the future. And so, like, again,
actually, there's thinking with Aptos.
I'm saying assets
equals an apartment.
Exactly. That's where it came from. One APT, one apartment, one Ondo, one condo. I'm saying assets here. By no means do
it's the future of finance, boys.
To buy or that I hold them nothing. But this exists, Tyler.
I understand that is, it's so far in the future that it might be something someday, but there is no inherent value in that. I just need to state that. It's okay to trade it. It's okay. It might turn out to be Google in 10 years and you're a genius if you hold it and everything. I'm just like,
No, they're not going to turn out to be Google, and they're overvalued and they're going to go down 90%. But the point is, what you said is true, Tyler. They're trading on a story. That's it, nothing else. And when that story evaporates, when the crypto market turns, see ya. But like, it's happening. What you said.
I agree, and like I look at a lot of public proxies, like the UFO ETF is the space ETF, and I kind of think about space as like altcoins similarly, where it's this great story. It's like there's a lot of stuff happening in space, and honestly, SpaceX is making a lot of money, but this UFO ETF, it just broke out from the weekly, just broke out from a lot of moving averages. But the funny thing about it is the story really is about there's not enough space companies to invest in. And there's a lot of capital that can incrementally push it up. So if you find these themes in a liquidity cycle, you can make asymmetric returns. I just would rather do it something that is good for society. Like if you go to space and you figure out like new innovations rather than one ondo is a condo, like who the heck, I'd rather put my money in something existentially that's good for society than that just be a riverboat gambler.
So okay, weed stock.
Weed stock.
Hey,
man, the weed is good for society.
Would you rather have every pharma company selling you on mainstream media of all these weird drugs and buying out corporations? Weed is the solve for that.
Actually, I do think
mushrooms.
There's a strong case for those mushrooms, and I do think just having gone through like back pain and having gone through, I don't know. There are some flaws with Western medicine. I'm gonna say, like, 100%. So Jason's wife, her dad ran John Hopkins Medical System and now runs a hospital system. He had horrible back. So when I was like, I couldn't walk, he introduced me to talk to him, and I was like, so dude, what should I do? He was like, well, for me, it was honestly nothing in the hospital system that worked. It was just like deep tissue massage,
grass,
acupuncture. Yeah. And he's like a huge Eastern medicine guy. I was like, that's interesting that a guy runs a hospital.
Jason's chill. He's chill.
Yeah. Yeah.
There's this back
his father-in-law, but yeah. I might not be. Maybe I'm outing him. Maybe we should cut this.
there's this back book. Have you ever heard of this? It's every Wall Street guy when they have back problems sends it to each other. And one of the opening chapters is you stare in front of the mirror and you just tell yourself, you're not fucking hurt. You're not hurt.
No, it is. Yeah, it is. And it's a state of mind. It is crazy.
It is. Dude, a lot of chronic pain is mental.
Yeah.
A lot of chronic pain.
It's all mental. Stuff. That's my favorite line. It's all mental. It's like, you should do some hot yoga though, Mike. That's the real deal. Hot yoga.
I did that, and I gotta start doing what's the other one? There's like honestly, a lot of what it is just strengthening. It's like these deep muscles that aren't firing.
We might make this a 2-hour show going forward. First half markets, second half health and wellness and lifestyle.
Yeah.
The biohacking crowd will love us.
Whenever I tweet about back problems, it gets like hundreds of likes. I get floods of DMs from people being like, if you've struggled through this, like I've had these long conversations with people that, so it resonates. We should add a segment.
I have a infrared sauna and a cold plunge, and I go 30 minutes in the infrared sauna at like 165, and then I jump into the cold plunge. And I swear my circulatory system, it's like my veins open up and then they freeze and they open it. I'm going to live till I'm like 140.
I believe it.
Dude, the two best thinking places are the cold ideas is cold plunge and airplane. Those are where I get my best investment ideas.
Before we turn into a Joe Rogan podcast here, talk about biohacking and saunas. Let's wrap it up with some market-based meme of the weeks. But I posted this one on my Twitter and I proudly made it myself. But I think this might have been at the near bottom of the friggin' systematic flow moment. But we mentioned this in the chat. But I think like value, for those that don't know, VAR is value at risk, and it's just basically a risk model that a lot of funds utilize on a day-to-day basis for just how much like drawdown they can basically be comfortable with in a day. And it's honestly one of the few edges that we can have as small investors is that, when these guys get the tap on their shoulder, they just got to nuke it until that number gets in line, and it does not matter to them. Whereas us small guys, like we can either hold it, we can be the buyer on that other side of that irrational selling. And, it was just a really funny moment to see this. And I felt like I was mark safe from this the other day.
Yeah. You know what is the best contraindicator ever? And I've posted this on Twitter like countless times, but when the VIX curve inverts, it's basically a sign for all this VAR degrossing that they max long vol. And now the VIX is down 10%, 3-month VIX is down 7%, and that's unwinding. But yeah, you totally nailed it. I'm wondering when the active managers start picking this up and then it really becomes a detriment to the quant guys. It's just really hard to know. During the buyback blackout periods, this happens like almost every time now. When are the active funds going to take advantage of it? Because all these, and I call them stupid MIT programmers as a joke, but like all this stuff is programmatic. And now I think people are realizing, oh my God, we can take advantage of it. So the performance should shift now. Like,
totally. I always find it how funny, like so much of the stuff is based on expected value. And a lot of time, like expected value is, it can be as quantitative as specific as possible, but it's also still based in probabilities. Like it's not as certain as people think.
So true. So true.
We have a second meme of the week. Do you want to talk about this one, Tyler?
No, that was just me. This nails everything. People living paycheck to paycheck, landlords living month to month, banks and corporations living bailout to bailout, U.S. government living war to war. This is the synopsis of modern
That's how
day
society works.
now. But I do think we're going into a first turning, new institutions, new political philosophy. It's coming. It's coming soon to a theater near you.
This one kind of slaps for me. I mean, in like the worst way possible, because it's like there's so much internal strife in the US. It's like the best thing for internal strife is an external enemy, which sucks. It sucks that that's how humans work, but I mean, there's so much evidence to suggest that it is on almost every level of organization. So
good one, boys.
All right, guys. Well, thanks for a great episode. And Mike, the door's always open. Come on in anytime.
Parting words at 12:11 Eastern on Friday, July 26th is to look at the chart of Bitcoin, and it's just accumulation mode. And, I wouldn't be so quick to sell the news of this Trump thing. I think there's real macro shifts coming.
I wish Quinn was bearish so I could be more bullish, but I'm with you. Let's ride it.
All right. We'll check back in next week.
Yeah. See you guys.
cheers,
Later.
Guys.